And this, hi Dom, the first of our new Market Navigator segments. Will be on the hunt for overlooked market signals and guide you through advanced trade ideas to hedge your larger portfolio or maybe look to generate some opportunistic gains, shall we say, on the side. Mr. Chu, thanks for joining us for these. Looking forward to hearing all of that. So what are we doing today?
So what we're going to look at today is the massive amount of moves that we've been seeing in the volatility index, that fear gauge. It's indicative of actual market conditions. Is it now, right now, indicative of what's happening or what's going to happen in the future? Or is something else at work behind the scenes? In other words, just how much should we fear the so-called fear index? That's going to be our key question. Okay. So joining us today is Brian Stutland, the Chief Investment Officer of Equity Armor Investments. You can see him right over here. Brian, thank you very much for being with us today. If you take a look at the VIX, what was the thing that stood out to you with regard to the index? What kind of charting did you see? And can you walk us through what exactly was the biggest thing for you during the market volatility?
Well, when you look at the VIX here, it actually has a lot of feel of what happened back in August of 2007, what happened in the fall of 1998. These market moving events where you had a few things go wrong for the market, you had a little bit of lack of liquidity occur, and then all of a sudden you get the third strike, which people blame the yen carry trade on, to create some market dislocation. Now look, we saw a lot of selling in the Mag 7 here in the middle of July, and those are major weightings in all these indexes and ETFs. So now you have billions of dollars being sold across the board in areas of the market, and that ripple effect really carried over, and we saw this huge spike and the VIX volatility levels sort of indicative of what happened here, and the selling sort of progressed very, very quickly, and people, basically dealers, looking to cover some hedges and just sell into this market.
Now, in other words, Brian, there's been a regime of low volatility and people basically collecting insurance premium for months and quarters now without any fear of having to ever pay out on the insurance policies that they collected premium for. Is it fair to say that the volatility spike that we saw is because all of a sudden the chickens came home to roost and that all of a sudden these insurers would actually maybe have to start paying out against the policies that they've collected so much money for? Was it like picking up pennies in front of a steamroller?
Dom, it really was, because what basically happened is what we saw is massive amounts of demand for puts to the downside, whether it was people covering all these short positions that they had in the volatility space or whatnot. But basically, call buyers dried up, put buyers came into the market, and then, of course, the market makers and the dealers that are now having to sell these puts to people trying to cover their insurance basically have to sell into the market to stay neutral to it. So massive amounts of selling from dealers, and then obviously all those people trying to pick up those pennies down in front of a steamroller, getting steamrolled and having to panic and get out of this market really caused the spike in volatility. When we see that high demand for puts on the downside like we saw, this has maybe only happened a handful of times literally over the last 15 years. This level of demand for puts can really shake up the market, and I think that's what drove the VIX to significantly high levels.
So, Brian, give us your trade here. Now that we've seen today unwind a good bit of what happened yesterday, do you have a $1 billion idea for the next 24 hours or a longer-term idea or anything come to mind?
Yeah, actually, I do. And this is something I've been looking at for clients actually throughout today, is when we've seen this occur before, I said this has happened maybe 5 times over the last 15 years. What happens is the next couple days of the market afterwards, we get a sense of, is there going to be a reversal or people sort of covering back to what they had? And we did, in fact, see a little bit of that, where basically we saw some call buyers come into the market on the S&P 500. And now, all of a sudden, we have some upside momentum going. And so basically, I think you can put together an options trade that I've constructed where I want to buy a call spread and finance it. I want to play to the upside here, because when this has happened, when we've had this level of panic in the market, there's some opportunities to be had. So I can buy a call spread while at the same time minimizing some of that cost by selling a downside put. So I'm looking in the SPY. This is a spider ETF on the S&P 500. I'd be looking to buy that call spread and sell the 500 strike put against the 538, 558 call spread out to September. I only have to pay $1 for this. And this is the $1 billion idea, so to speak. I pay $1. I basically don't have to own the market until down at 500 on the spider ETF. So that's about 5% to the downside. I have a cushion here, and I get to participate to the upside from 538 to 558. And when we've had these washouts before, like I talked about, It seems like the next 3 to 6 months, there's a rally. I'm not sure if this is August 2007 and all of a sudden, we're in trouble 6 months from now, or if this is 1998 and there's this euphoria and the market just gaps higher. As the Fed started cutting rates back then, it looks like they're going to have to cut 50 basis points now in September.